But Rick, no one's talking about inflation, really, are they? And I speak to people and they're like, oh no, inflation's not, but it's here. It's just no one's talking about it.
Carrie, I think I have this figured out. People's expectation of the future is set by their experience in the immediate past.
Yeah.
And the last 40 years that we've lived through have been extraordinarily benign. In 1981, the US 10-year rate was 15.6, 15.6.
That's right.
Now it's 1.2. So we've lived through a period of falling interest rates. We've lived through a period of increased liquidity. We've lived through a period of increasing real estate prices, increased securities prices, and we've been trained that things just get better and better. We've been trained too to believe that government, not individual initiative, is responsible for this. I guess in Australia, your government must have found the Pilbara. They must have found the Queensland coalfields. All of the good which happened in Australia is obviously due to your government. The same in the United States, of course. Yeah. If your expectation of the future, is set by your experience in the immediate past, what the immediate past tells you, 40 years of immediate past tells you, is to be brave. But things change. We're seldom prepared for change. I remember through the decade of the 80s, which was characterized by falling interest rates and falling prices, that because of 15 years of inflation, prior years of inflation, the expectation all through the 80s, when we weren't experiencing inflation, was inflation. After 40 years, that fear has been beaten out of us.
Right.
It's really pernicious, though, Carrie, if you think about both inflation and low interest rates, what happens to savers?
Yeah, they get decimated.
They get absolutely slaughtered. If you look again at the US 10-year Treasury, somebody's getting paid 125 basis points in a currency that's depreciating by 5.5% a year. In other words, savers are losing 4% a year compounded. My friend Jim Grant calls that return-free risk. At the end of 10 years, including the compounding, the saver has lost almost 2/3 of his or her wealth. I guess the upside of this, if you're a big government person, is that for the first time in my life and yours, Carrie, the government is telling you the truth. If you give them money, they will give you back less 10 years from now than you have today. That's their solemn promise, and they're going to keep it.
But most people don't actually view it that way, because the majority of people out there, and it's not a shame, but it's kind of a worry for me that the majority of people think that they've got to save. Like, for example, here in Australia, Rick, with the property market continuing to be on fire and out of control, the people that don't fully understand this are just trying to save to keep up, and in fact don't realize that they're going backwards. What would you say to those people?
Well, perversely, I would say keep saving, but invest while you save. I think true too, Carrie, that despite the fact that your cash savings generates you a negative real yield, perversely, you have to keep holding some cash. Because if we have a liquidity squeeze, that cash will give you, hopefully, both the courage and the means to take advantage of a liquidity squeeze rather than being taken advantage of. Despite the fact that I know that my own cash holdings are costing me 4% a year compounded, I have fairly high levels of cash. The reason for that was 2008. When the 2008 crash happened, I was similarly cashed up. And the consequence of that is that 2008, 2009, and 2010 were extremely pleasant for me. When other people had to sell, I got to buy. I consider for investors and speculators that the negative interest rate that you suffer through is a form of option premium. It gives you the ability, should, as an example, major equity indexes fall by 50%, to do some well-timed buying.
What do you think? Sorry to interrupt you, Rick. You mentioned a liquidity squeeze. Just expand on that a little bit for me, because at the moment, people are not seeing that. The markets are going up and asset prices are going up and everyone's living in this warm, fuzzy bubble. Do you think that this can go on for a lot longer? We've spoken about this before, Rick. Do you think that the liquidity squeeze will come? You say that you've got cash at the moment, which indicates to me that you think that there could be something not too far away.
In a fairly recent talk, Warren Buffett said that 4 times during his stewardship of Berkshire Hathaway, that it's fallen 40% or more over 18 months. Arguably the finest, strongest, best run, most diversified company on the planet, 4 times in 50 years has fallen by more than 40%.
Wow.
If a company that is that strong is that susceptible to the whims of the market, what can you say about the broad market, which is, let's just say, arguably somewhat less well run than Berkshire Hathaway? Could the market decline for 30 or 40% for no reason whatsoever? I don't see why not. I think it's likely that more and more people will be concerned about precisely the arithmetic that you and I went through in this interview.
Mhm.
My suspicion is that it's more likely than not that people will become more cautious. And I suspect that we will see sometime in the next 5 years, let's just call it an interesting shock to the equities market. Let's think too, Carrie, about the circumstance that would happen if there was a broader realization of the truth.
Yeah.
Quantitative easing is counterfeiting.
Mm.
I mean, it is a simple truth. Or let's say that the Australian government or the US government gave a bond auction and no one came. People forget the rise of Roger Douglas, a Labour politician in New Zealand. That didn't come about because New Zealand's dairy farmers were eager to give up welfare and price supports. It happened because New Zealand was functionally bankrupt. Well, Roger Douglas was the Labour prime minister who was able to fashion the economic reforms that propelled New Zealand so well over the last 3 decades. A Labour politician wasn't predisposed to end subsidies, reduce regulation, cut tax, and do all the things he had to do. He did it because he didn't have a second choice. New Zealand was the first developed nation in the world that had to threaten to default. Similarly, the economic reforms that you saw in Canada in the early part of the decade of the 80s by Jean Chrétien didn't happen because he suddenly got a dose of Austrian economics. It happened because I think it was first Ontario Hydro, and later the government of Canada came to US debt markets, and the bond buyers said, no, thank you. No more money.
Yeah.
Could this happen to a broader range of credits? In other words, could private bond buyers refuse to buy bonds? And could the market shut on quantitative easing? If we had a US Treasury auction, let's say that the US Treasury went out to raise, some paltry amount of money, like they do, $50-60 billion. And let's say that they came back with bids for 15 billion and they had to counterfeit 45 billion. I think the impact of that on capital markets would be substantial. Am I saying it's going to happen? Eventually, yes, I think it's going to happen.